Hey everybody, Jay Alexander here with Homestar. Had some new economic data. Haven't done one of these updates here in a minute, so wanted to get some information out there. Had a big consumer price index number come out today that's really kind of started off by rattling the market this morning. So let's get into this, kind of look at what's going on and what it means for today's real estate with our buyers and kind of what I think we should expect moving forward. So first things first, let's break down the September CPI numbers. It wasn't good. The headline CPI number for the month came in at 0.4% versus estimates and expectations of 0.2% increase in pricing. Year over year, that puts us at 8.2%. That means on average we're paying 8.2% more for the items we typically buy than we were at this time last year. And again, that's higher than the estimates of 8.1%. The other number that was a really big miss from the report today was the core CPI number. It came in at 0.6 month over month, which goes to 6.6 year over year versus estimates of 0.5 and 6.5, both month over month and year over year. One thing I want to point out about the CPI number is one of the big components of it that really drove these numbers up was rent. Rent was up 0.8% month over month, and that means we're now, I think it's the highest it's ever been on record, 6.7% year over year rent increase. And that's a good talking point, I think, for potential buyers in this market, especially people who are first-time home buyers or who are currently renting. It's like, look, the effects that we're seeing in this economy right now are from inflation, but you're not going to be insulated from inflation by not purchasing a home and by continuing to rent. And I think we all know that. I think lots of people believe in home ownership versus renting, but the CPI numbers today at least confirm that for us as well. So not a good number today, definitely a miss. And this is a key number. It's going to have an impact ultimately on what happens with Fed policy and Fed raising interest rates. So getting into that real quick, you've seen this slide before. The Fed bumped rates. They've bumped it 0.75 of a point the last three meetings. So June, July, and September all saw 75 basis point rate hikes. We're projecting another 75 basis point rate hike in November. December's still up for debate. Again, there's some hope that these Fed rate hikes will come into play and slow down inflation, but we haven't seen that yet, unfortunately. And I think so far everything's still open for another 0.75 rate hike in December. We'll see how it plays out. But everything from the Fed, all of their press releases are all, hey, we're very concerned about inflation. We've got to get inflation under control, even if that means some temporary pain in the economy. And the Fed has all but come out and said, as close as the Fed will ever admit, that basically the goal or the hope for a soft landing with the economy, which means raising rates but without sending the economy into a recession, it pretty much there's not a chance or a shot at being able to do that anymore. And the Fed is now projecting the unemployment rate to climb, I think, half a point going into next year, which is kind of them basically admitting that, hey, we're going to see a slowdown in the economy. We're going to see the unemployment rate go up, and that's probably the last thing that we need for it to be officially called a recession in this economy right now. So, like I said, the CPI numbers and the jobs report that we got last week, which also came in hotter than expected, is leaving the door wide open for the Fed to continue bumping this rate in order to get inflation under control. Well, for mortgages right now, what we're dealing in the mortgage business, this has several impacts. The first thing that we're seeing in the mortgage business is a lack of liquidity. Now, there's a couple reasons for this. One of them is volatility. And the idea here is you've got investors who want to purchase mortgages, but these are investors that are looking for a long-term fixed rate asset to invest in. And typically investors for mortgages like to see a pretty consistent price. And this data we have right here, guys, if you don't understand or not familiar with candlestick charts, don't worry about it. Just know that a typical day in the mortgage business, in the mortgage market, These smaller candles that take up smaller space here on the chart are more of a typical day in the mortgage business. You have occasionally a larger candle or a bigger day, but overall we should see not a whole lot of movement in the mortgage market. Well, here lately, the past several days, these candles, these movements are just huge. It's very, very big movements. A lot going on in the mortgage market, in the mortgage business. This is extremely volatile market. On a given day, we may have a mortgage price just totally different, all within a matter of a couple hours or even a couple minutes. And that makes it real difficult to find buyers for mortgages, because investors want these prices to kind of plane out and get level before they know how much they want to buy and what they're actually investing in. No one wants to purchase a mortgage and then it go way down in price a few minutes later or a day or two later. So this is causing a liquidity problem, and so that's one of the issues. But the bigger issue that's causing a liquidity issue, and guys, liquidity is just Wall Street speak for no one wants to buy it. And the reason investors in general do not want to buy mortgages right now is the fact that there is an expectation that mortgage rates will improve in the near future. The reason nobody wants to buy a mortgage when we expect rates to go down in the near future is a mortgage, believe it or not, when a customer takes out a loan and they start repaying the loan and paying the interest on the loan, the interest to make up for the cost to produce that mortgage doesn't typically break even until the customer or the buyer's made 2 years worth of mortgage payments. Well, you can imagine in today's market, if a customer closes on a loan at a 7.5% interest rate, and then in the next year or 18 months, rates go down to say 6 or 6.5, those people that purchased homes are going to refinance, and then that entire mortgage that was funded and worked for that 12 months or 18 months or whatever it is, that is a mortgage that loses money. So as the rates improve, people will refinance. Investors know that. So what investors are saying, or what's happening in our mortgage market, is like, look, we're not going to give you a bunch of money for a mortgage right now. Investors are essentially requiring some money or profit up front, and that trickles down to our rate sheet in the form of discount points. If you're paying attention, or if you've closed a lot of transactions recently on the real estate side, people getting mortgages, you'll notice that closing costs now are high. They're higher than they've been in a while, and this is the reason why. It's investors don't want to pay up front for a mortgage and expect to recoup it over time in the form of higher interest. Even at a higher interest rate, at a 8 or 9% interest rate, investors are not giving more money for that mortgage, because the expectation is as the rate goes up, the customer has even more incentive to refinance as rates go down just a little bit. So the lack of liquidity, or the fact that costs are higher right now, the closing costs are higher on a mortgage, is directly tied to the fact that overall there's an expectation for mortgage rates to improve in the near future. Now, why do we think that? I've showed you this chart before. We do have history to look back on when the Fed is fighting inflation. And look, here at the bottom, Jerome Powell, he's our current Fed chair. We've seen inflation jump up. We've seen mortgage rates jump up. The Fed is targeting a higher Fed funds rate than we have right now. This needs to be updated. It's not 1.75 currently. It's actually 3%, 3 to 3.25 is the current Fed funds rate. But these three items have not happened yet. We haven't seen inflation really come down yet. Again, that's the data point that we got today from the CPI was just not good. It was certainly a miss. As a result, since inflation has not come down, we haven't seen mortgage rates come down, and we still haven't officially called a recession. We've seen GDP, we've seen negative growth in the economy or a shrinking of the U.S. economy, but with the jobs report still being good and unemployment rate still being low, we still haven't officially called a recession yet. So I do think we'll get there on all three of these points. I do think you'll see inflation start to come down. We're probably at the peak now. I think beginning with the next report, about 30 days from now, we'll see inflation start to mitigate. We'll start to see mortgage rates, once that data comes out, start to finally peak and slow down. And then I do think that will be, unfortunately, accompanied with a little bit of an economic slowdown, a little bit more jobless claims, maybe the unemployment rate increasing. and probably officially a recession being called in the U.S. economy. So that's what we're projecting moving forward. The challenge with this is, we never know exactly when it will happen, and it leads to the question of, okay, well, if I'm a buyer in today's market, if I need to buy a house, if I'm out there trying to figure it out, what solutions do we have for today's buyers? And I'm going to shrink this screen right here so you guys can see this. So one solution that we have is permanent buy downs, and this is a real common way to structure a loan. So the idea is for a loan amount of a $350,000 loan today at a 7.5% interest rate, the principal and interest payment on that loan would be $2,447. If a customer elects to do a permanent buy down, they can essentially borrow all this money, the $350,000, at a 6.875 interest rate. The principal and interest payment drops. It drops to $22.99. But in exchange to get this lower monthly payment, the borrower would have to pay an additional $7,000 in costs or discount points in order to get the discounted rate. Now, this is effectively $148 a month in savings, and it takes the customer almost 48 months, or right under 4 years, to break even in this scenario. I am personally not a big fan right now of clients using permanent buy downs. One of the big reasons is the fact that it takes 4 years to break even, and I really think there's great opportunity for the market to improve and for mortgage rates to improve, certainly within the next 4 years. So what I'm telling customers is, I'm like, look, you can pay $7,000 today to get 6.875 on your mortgage, or you can just close at 7.5 and wait until the market gives us 6.875 for free, and then you can refinance into that loan. Okay, so it's now for the right customer, the right scenario. Maybe we have someone on fixed income and they have to have their payment at a specific number. There are scenarios where a buy down can make sense, but overall, I really don't recommend that for a customer in today's market, just because I do think there will be an opportunity in the near future for the customer to get these lower rates and not have to pay for it, or they can save this money and use this money to refinance and maybe get a lower rate than the 6.875 here in the near future. But that is a solution for customers. That is something that we'll look at for them. Another thing that's getting real popular right now, and I am a fan of this, is not a permanent buy down, but a temporary buy down. Now, this can be structured multiple ways. There's 1-0, 2-1, and 3-2-1 buy downs. The idea is that the customer starts at 1, 2, or even 3 points below the note rate of the loan. So on the example before, if the note rate is 7.5%, the customer, if we do a 2-1 buy down, they would start off initially at a 5.5% rate for the first year. It would be 6.5% for the second year, and then finally it would cap out and permanently be at the 7.5% rate for years 3 through 30. And you can see here the principal and interest, the payment starts off lower and then creeps up every year as that goes up. So I like this scenario because it's not quite as expensive to do this, and you get much more bang for your buck for our customers. The other reason I really like a temporary buy down is that if the buyer sells the home or refinances during the buy down period, so during the first 2 years, if the customer refinances or sells the property, they still receive the full benefit of the buy down. Any money that's not used that effectively reduces this payment for the first 2 years in the buy down, the money that's there will be used as a principal reduction. Basically, the customer's loan amount will be less when they go to pay off this loan when they either refinance or sell the property during the first 2 years. Whereas on a permanent buy down, if the customer sells or refinances the home during the first 4 years, they've lost money with this buy down. They've never recouped the $7,000 that it took to buy the rate down from 7.5 to 6.875. So just in this market, knowing the history when the Fed's fighting inflation, what we expect the economy to do, and what we expect to happen to mortgage rates, I'm a much, much bigger fan of a temporary buy down than a permanent buy down for our customers. So definitely pushing that, definitely recommending that to customers. And I think it really makes a lot of sense. And even if rates continue to go up and they stay up for an extended period of time for the next 4 to 5 years, well, even then the customer at least got to have the lower rate for the first 2 years of the loan. That's 2 years of working and hopefully getting pay raises and job promotions or better job opportunities and things like that, to where paying essentially what comes out to be, remember, versus the permanent buy down, it's only $148 a month in savings. The hope is that by year 3 of this loan, if rates do stay elevated and continue to go up, it's not as big a deal for the customer versus coming up with $7,000 out of pocket in order to buy down the rate and save $148 a month on a permanent buy down. So food for thought. I do like a temporary buy down in this market right now. I think that makes a lot of sense. Another solution that we're giving buyers is the idea of some mortgage insurance solutions or mortgage insurance scenarios where we buy out the MI. This only works for conventional loans, so this won't help our government customers. But the beauty, again, of a mortgage insurance buyout, looking at this worksheet here, you can see the PMI for this customer that we have estimated just for a scenario that I've ran is $228 a month. So we can structure this loan where the customer doesn't have this monthly cost, where this PMI is either financed or covered in the cost of the loan. And if the customer goes to refinance anytime, year, 2 years, 3 years later, as rates go down, they can still reap the benefit of having no MI. That refinance can be done and the customer can maintain the no mortgage insurance on their loan. So I think structuring loans right now, looking into the future and expecting a refinance of the loans that are going on the books today in the next, again, probably 12 to 24 months, I think structuring the loan, anticipating that and making sure the customer gets the benefit of refinancing is critical. I think that goes a long way into helping people get into homes. Certainly, guys, if you have questions on this, you can always give me and my team a call. The phone number's here on your screen. You can always reach out to me, here on Facebook or YouTube, wherever you see this video. Hope everyone has a wonderful day. If you have any questions about these numbers, please feel free to post them. I'll do my best to get the answer for you if I don't know it. And hope everybody has a wonderful evening today, great day, and look forward to talking with you soon. Thanks.